And of course, it's the quarterly MPT appearance by the Governor of the Bank of Canada, Stephen S. Poloz, and Carolyn Wilkins. And a reminder that she is the Senior Deputy Governor of the Bank of Canada. And I believe they have between 5 to 10 minutes of remarks as usual. And then we'll open up the question list in a second. And I'll do that with the proper waving of my hand so we can all be equal. And I will hand it over to the Governor.
Okay, well, thank you, Chris. Good morning, everybody. Bonjour tout le monde. Senior Deputy Wilkins and I are glad to be with you today to talk about the June issue of the bank's Financial System Review, which we published this morning. Now, let me start with a quick reminder about the purpose of the FSR. It identifies vulnerabilities in the financial system. These are pre-existing conditions that can interact with economic shocks, and it monitors how they are evolving through time. It also looks at the potential impact on the financial system and the economy if a shock were to interact with or be magnified by these vulnerabilities. Canada's financial system remains resilient, and this resilience has increased because the Canadian economy has strengthened since our previous FSR in December. Still, the two most important vulnerabilities for Canada's financial system, that's the elevated level of household indebtedness and imbalances in the Canadian housing market, have moved higher over the past 6 months. On the first, the level of household indebtedness in Canada continues to rise. A good portion of this increased debt consists of mortgages and home equity lines of credit located in the Greater Toronto and Vancouver areas. Last year, the federal government introduced changes to housing finance policies aimed at improving the quality of borrowing. And there's evidence that these changes are working. This is particularly true for insured mortgages, where more than 80% of the cost of the home is being borrowed. We've seen a drop in the proportion of insured mortgages being issued to highly indebted borrowers, that is, people whose debts are more than 450% of their income. This is a positive development. However, we are now seeing more uninsured mortgages being issued, particularly in places such as Toronto and Vancouver, where prices are the highest in Canada. In part, this is to be expected, given that insurance is not available for mortgages on homes with a price greater than $1 million. Still, some of these uninsured mortgages are showing riskier characteristics. A growing share is going to people who are highly indebted, and these borrowers are amortizing the mortgages over longer periods. As well, we see some evidence that people are borrowing from other sources to put together enough of a down payment to avoid the insurance requirement. This could be a concern, depending on the source of the borrowing. Imbalances in housing markets, the second vulnerability, have also grown since December. Policies aimed at cooling the Greater Vancouver area market appear to have had only a temporary effect, as sales and prices are rising again. Similar policies have recently been implemented for the GTA. While the most recent average sale price in the GTA has declined, that followed significant price acceleration over the previous year across various dwelling types. There's a map in the FSR showing that large price increases are now being seen across that region from Niagara all the way to Peterborough. Now, we expect macroprudential and housing policy measures to help mitigate this vulnerability over time. And I would point out that housing market fundamentals remain very strong in the Greater Toronto and Vancouver areas, with solid growth in population and employment. However, fundamentals alone cannot explain the price movements that we've seen. And there's evidence that extrapolative expectations continue to play an important role. Cela est important car il y a plus de chances qu'une correction se produise lorsque les prix augmentent à un rythme plus élevé que ce que laissent supposer les facteurs fondamentaux. Et quand les anticipations extrapolatives sont à l'œuvre, il y a toujours un risque qu'elles se renversent soudainement et amplifient la baisse des prix. Étant donné l'évolution de ces deux vulnérabilités, la Banque s'est penchée sur les deux scénarios de risque les plus lourds de conséquences pour l'économie canadienne. Nous avons notamment étudié à nouveau un scénario dans lequel une grave récession provoque une correction des prix des logements. Nous avons aussi envisagé un scénario distinct, plus restreint celui-là, dans lequel une correction des prix des logements survit d'elle-même sur des marchés régionaux particuliers sans avoir été provoquée par un choc extérieur quelconque. Selon le premier scénario, une grave récession entraînerait des pertes d'emplois généralisées et des baisses de revenus, et des ménages fortement endettés seraient les plus durement touchés. Il s'ensuivrait une correction des prix des logements qui aggraverait les effets de la récession. Cela pourrait faire apparaître des tensions dans l'ensemble du système financier et de l'économie. Du fait du dynamisme affiché par l'économie canadienne ces derniers mois, il est de moins en moins probable que ce scénario se concrétise. Mais, s'il se confirmait, les incidences possibles pourraient maintenant être plus importantes parce que les vulnérabilités sous-jacentes se sont accentuées. The second scenario we looked at involved a significant house price correction in the Greater Toronto and Vancouver areas. Such a correction would hit the BC and Ontario economies, affecting spending on housing and related goods and services. There would be some spillovers to other regions and sectors of the economy. Bank balance sheets would also be affected in this scenario, leading to tighter lending standards. Now, the likelihood of this second scenario occurring is greater than the first. However, its impact would be less severe, and we don't anticipate that a house price correction would trigger the widespread rise in unemployment assumed in our first scenario. Now, given recent events, some people might naturally wonder if there is a connection between the two vulnerabilities we've described and the situation at Home Capital. While we don't generally discuss individual financial institutions, I can say that our assessment is that the situation reflected firm-specific factors. The regulatory and supervisory system worked as it's designed to do, and we're not seeing signs of broader stress. Indeed, those recent events were a pretty clear indication of the resilience of Canada's financial system as a whole. So let me close by pointing out that the FSR includes a section that describes how we measure the resilience of the Canadian financial system. It shows that capital, leverage, and liquidity ratios in the Canadian financial system are all well above regulatory minimums and have improved over the last year. We're seeing early signs of recovery in business investment, and the process of adjustment to the oil price shock is mostly behind us, having been facilitated by the monetary policy actions that we took in 2015. This improving economic backdrop will add to the resilience of Canada's financial system. And as such, we decided to drop the risk of prolonged weakness in commodity prices from our risk assessment. And with that, Senior Deputy Governor Wilkins and I are happy to respond to your questions.
Thank you, Governor. It's the standard one question, one follow-up. We'll begin with Shirley Engel of Global National.
Thanks, Governor. I wanted to ask you about household debt, and you talked about the increased vulnerability, and you specifically mentioned the greater use of home equity lines of credit. This is something a financial consumer agency warned about yesterday, Canadians using their homes as ATMs. How concerned are you about it, and what role do you see HELOCs playing in the housing frenzies in Toronto and Vancouver specifically?
Well, the HELOC structure is the ultimate in flexibility for consumers. There's considerable benefit to consumers to be able to operate their own affairs with flexibility and indeed to use those facilities perhaps for home renovations or that sort of thing. Of course, it's also gives one extra flexibility when it comes time to perhaps to buy a second home, whether that second home is for the purposes of moving to it or in the more concerning situation where it's being used to speculate on higher prices of homes, perhaps while they're being built, that kind of thing. And so again, just like many other financial tools, it's all about how one uses them. And so I think FCAC's report yesterday was a timely reminder for consumers about how these tools can be used and to help them understand exactly how the implications work through time.
Can you draw a link between the increased use of these vehicles and what we're seeing in terms of prices going up and people buying more properties and taking on more debt?
Well, buying houses generally requires credit, and what we've noted is that traditional mortgages, although they're growing faster, indebtedness is growing faster than the economy, say around 5%, possibly a little bit more than that, closer to 6% at times. That's not a lot of growth in mortgage credit, considering what we're seeing in certain markets. So the fact is then, if the HELOC structure is permitting more of that kind of speculative activity, then it may be part of the narrative. I'm not going to point the finger at the blame or anything like that. It's just that it just helps people if that's one of the things they'd like to do. And so, this is, like I said at the beginning, it's a very flexible financial tool. Would you like to add anything, Carolyn?
Well, I think you covered it, actually.
Okay.
Paul Vera, Wall Street Journal.
In the review, you've labeled or judged the risk of housing correction as moderate. Does that mean 50-50? It's higher than, it's a bit high. It's not high probability, but can you explain what moderate means? And can you also explain when you say that the impact would be limited, but would still cause financial stress?
Right. So in the FSR, generally what we're trying to analyze here are low probability events, but with substantial consequences. Most of our analysis is spent on the actual underlying vulnerabilities. The metaphor I've used before is like a crack in a tree. So you analyze that crack every spring or every fall, and you decide if you need to take that tree down or if it's healing itself, et cetera. It just needs the right kind of wind to come along to knock that tree down and perhaps cause some damage. So that's the risk. The vulnerability is the crack. So we spend most of our time on the vulnerabilities, and the reason for that is because as in doing policy, what we're usually analyzing is a shock to the economy, and how does that work its way through the economy, and what does policy do about it? And so when there is a vulnerability present like that, what can happen is the effect of the shock can be magnified as it works its way through the system. And one of the consequences of that magnification can be a financial stability risk emerges, something which puts the system itself in danger. So we are only looking at what I call extreme events. So we look at something that's got a little bit more probable, more likely than something else. Both of them are still what economists call tail risks. There are things we need to be mindful of, but no one's predicting that they're about to occur. So that's moderate means more than low, but and through time, it's more comfortable observing that risk that we talked about, the risk of a price correction in specific housing markets, appears to be, in my mind, to be growing through time. So it's not just a static thing. It's becoming more of a vulnerability, not less. And that doesn't mean it's become highly probable or anything like that, but it's just something that we become more mindful of, and it's why we've broken it out as a separate risk scenario in today's report. Carolyn?
Yeah, I would say that instead of trying to put a number on the probabilities, I think the most useful thing is when you're looking at whether this is a risk to the financial system is to really look at how that vulnerability is triggered and turns into a risk. And in our minds, there's a difference between it materializing in a couple of important but localized markets and resulting in some retrenchment among households and maybe a tick up in arrears and things like that, but very localized, versus the trigger coming from some big shock to demand for our goods and services that could potentially come from externally, just as a scenario. Because that other scenario is really one where you'd see more generalized increased in unemployment, which we've always said has been, and losses in GDP and income, which we've always said in our previous analysis is a more serious case when it comes to financial stress. That being said, when you do stress tests on the Canadian financial institutions, it's pretty hard to come up with a scenario that really undermines their resilience when it comes to capital and liquidity.
In the FSR, in detailing the risk about the housing correction, there was a passage in which the bank or the authors of the review wanted to make it clear that Canada is not down the road toward a U.S.-style housing crisis. Why was that line put in there, and was the line put in there because there's still an impression out there that Canada is at risk of such a scenario?
Well, I think our job in a review like this is to offer up the kind of in-depth analysis and review, which is a contrast to that more superficial, oh, that looks just like other situations. And so that's a very easy conclusion for some people to jump to, and we want to make sure that people understand the underlying factors better. So, Carolyn, why don't you walk through the key differences?
It's important to look at the U.S. experience and see, to what extent there are similarities and differences. And I think, when you see house prices where they are and you see indebtedness, it's quite tempting to draw parallels. And at the same time, when you understand what really led to the severity of the financial stress in the U.S., which actually went global in 2008 and 2009, it was related to kind of a number of factors that are not present in Canada. And one of them is just the underwriting standards in Canada are high and they're effectively enforced. We're not seeing the kind of ninja loans, if you remember those. Just as an example, if you look at delinquency rates, they're historically low. They still are. I think really importantly is just a difference in the laws. Lenders in Canada have recourse to other household assets. It's not always the case in the U.S. And that changes the recovery rates for institutions if there's a problem, but it also means that households have greater incentives to hang on and not walk away. And then I think finally, and probably the most important thing, is just how the mortgages were financed in the U.S. was related to very complex securitization products that packaged up risks and spread it around in a way that was completely mispriced. And so when it unwound, it just amplified the situation. So what might have been a macro cycle ended up being a financial crisis. And so when you look at Canada, we have much less securitization. It's public, and it's plain Jane.
Bloomberg.
Good morning. Given that these risks in housing consumer finances are still edging up a little bit, are you near a point where you have to look at introducing the more flexible part of your inflation targeting mandate? To tackle, focus more
I see.
on the financial risks and less on a strict target of inflation?
Well, I think that we've come through the past pretty well over 2 years, where I think you could say that the duality of that risk management problem were in two different directions. We, in fact, 2015 cut rates twice to cushion the blow and facilitate the economy's adjustment to the oil price shock at a time when we were already pointing at these risks in the housing sector, and 2 more years have gone by, and they've edged higher throughout that. But as we said at the time, we felt that one of the most important contributions that we can make to this is to, if possible, facilitate the economy's recovery back to a normal track. because an unsustainable debt in one situation becomes sustainable when income is more certain, when employment is growing, et cetera, so that in effect the debt to income ratio looks better because income is growing better. And that's, so our primary mission being to keep inflation on target has that as an implication, that if there's going to be downward risk on inflation because of an oil price shock, well, we're going to adjust rates lower, and that's our main contribution. And throughout that, we've had some macroprudential adjustments to help contain and mitigate the risks in the financial system. But as I mentioned in my opening remarks, it's an important piece of the setting when we talk about these risks that the economy has shown more signs of strength in recent months. And we still have questions around sustainability and what risks we face on the macro front. But it certainly is a source of encouragement or comfort on this financial system analysis to know that you go into it with a stronger economy, better job growth, et cetera. And it does appear that the actions that we took in 2015 have done a good job to facilitate the economy's adjustment to that shock. So that's encouraging. So I mean, it just means, I guess, that there's less of a conflict between the two things that you're laying out than there was 2 years ago. Much less, I would say, much less of a conflict. Yeah.
The report mentions home capital and its troubles, and the report suggests again that it seems to be contained within the firm. Is it perhaps a bit overconfident to suggest at this point that that situation is under control? And given that, and that we've also seen the Moody's move on the bigger banks.
Right. Well, so you know, as I indicated, we really don't discuss the particulars of an individual financial institution. It's not our role, and our concern is primarily about the financial system. And we have in the past pointed to I mean, this is a sector which has been present. There's nothing new in there. It's just the alt lending sector has been there my whole life. Or at least my adult life, I guess. I don't know exactly, but anyway, a long time. And so you know, there are lots of folks out there who are, you know, who are self-employed or who have recently moved to Canada. Other cases where they just don't have the paperwork it takes to walk in and be approved in a bank for a mortgage in 60 seconds because they don't fit the template, you know. And so this alt sector does an important service. It fills that space. And you know, takes longer to kick the tires and do its credit approvals, but people do get a mortgage, and then as you can tell from the stats that have been published, that they have very, very low default rates. So it's a business that works. But we have pointed to the underlying potential for vulnerability in the funding model that such organizations tend to use. It's the fact of the business. They need to attract funding in order to make mortgages. And a lot of it is GICs, which is, you know, 1 year, 2 year, 3 year GICs. But some of it is more liquid kinds of deposits, and that leaves them vulnerable to a liquidity shortfall. Now that's just a situation. It's like I said, it's a vulnerability that we've pointed to in the past. We just saw a case here where that vulnerability kind of showed itself in an individual institution for other reasons. So I see that as unconnected to whether or not you know, somebody's analyzing the banking system as a whole and upgrading or downgrading ratings on the banks. That traditionally has been a focus on exposure to the housing sector. Well, our banks are always highly exposed. That's their bread and butter business. Unlike other banks in the world that offload that stuff, they keep most of it on the balance sheet, and that's the business model that's proven itself to be highly successful for a very long time. So, and they're still, whether they've been downgraded or not, they're still extremely highly rated. So, do you want to add something to that?
Yeah, on the funding side, I think that this market is serving a clientele that you know, at the right price can be underwritten. And so whether it's immigrants or small business people, the question really, I think, is a bigger question than any individual institution, is how big a market can be supported by this kind of stable funding sources that are out there. And when you look at the securitization market in Canada, it's mostly public, almost entirely public. And so the question really is there a capacity to develop a private securitization market for mortgages that's provides at the right price a more stable source of funding. And I think that those are the kinds of questions that private institutions are asking themselves. That's not new with home. That's something they've been asking themselves for a while. And I think that they're looking at how to build that market in a way that has the characteristics of what would be what you call a stable funding source. You know, that it's standardized in the underlying collateralization. It's got standardization in its structure, some high degree of transparency in how it's structured, and then some skin in the game, some risk retention. And that kind of market could be a new source of funding if it could be developed.
Andrea, Reuters.
I'd like to ask you about the separation of the risks, risk 1 and risk 2, a severe recession nationwide versus this house price correction in Toronto and Vancouver, and ask you why you separated those out. I'm wondering if there's an intellectual argument, or you're laying the groundwork for raising rates even if Toronto and Vancouver house prices are correcting. That you're saying, you know, it's not going to be that bad, man, you know, it's not as bad as this severe risk. We've separated this out so that we're give ourselves cover to raise rates even if it's just the prices correcting in Toronto and Vancouver, as we're starting to maybe see.
Okay, well, so it's actually a lot simpler than that. So you know, when we're observing these growing vulnerabilities, both household debt and housing market, which obviously kind of go together, right? Because a lot of the debt is just because house prices have gone up, and so that we still analyze them independently, because of course you could have a calming down in housing markets and you still have all that debt, so you'd still have a separate channel of which is an important vulnerability. So you keep them separate. But when it comes to risk, we're really just trying to create scenarios to illustrate how those risks might actually interact with the shocks, to help people understand why we are spending so much energy analyzing those vulnerabilities. And so you can imagine lots of different scenarios, but what we keep settled on, well, some time ago when we started doing this was, well, the most important scenario where all these things would interact and come together would be, you know, another probably global shock that causes, you know, GDP to slow down, you know, go into recession. And we might as well make it a stress test. So it's a significant recession that we put in, a significant rise in unemployment. And what we see in our models is there would be a pullback in all kinds of categories in the economy, including, of course, housing, and there'd be a housing price correction as part of that mechanism. So we have all those things going, and then we look and say, well, how would that combination of effects, magnified by the vulnerabilities we see, how would that affect the financial system, and hence its financial risk analysis? What we find is the financial system is quite resilient, actually, to those kinds of scenarios. And it's partly because we've historically had a resilient system, but it's also because the Basel reforms have upped all of the cushions that are used in that kind of scenario. Now, in the meantime, though, as time goes on, you see more and more evidence that price increases in Vancouver and in Toronto have an element of speculation to them. So that's a separate kind of, all by itself, kind of growing vulnerability. And as I said before, the longer that goes, the bigger it gets, and the more you start to be concerned that not necessarily a global recession, but just about anything could be responsible for causing a correction in housing, a trigger or a catalyst. It could be, I mean, literally anything. But it could be, a change in policy, or it could be just what we saw in Vancouver a year ago was prices just got high enough that through their own weight, it just, because you actually have to buy the house in the end. When the price gets really high, it can be hard to finish that transaction. So people start to back away as prices are so high. So in any case, whatever it is, we thought we needed to begin putting some energy into analyzing that scenario as a separate possibility that had, probably a higher probability, as we were talking before, than the one we were putting most of our energy into. So that's why we broke it out. It's not like decomposing it. It's just a separate scenario that could give rise to a correction in housing prices. And if that happened, what would be the implications for various spending categories in the economy and for the financial institutions with the mortgages? So there's nothing more, nothing deeper than that. It's just the facts on the ground lead us to think that that's worth understanding better than we weren't giving it singular attention before.
Well, then, if you're saying it's a higher probability, but it won't be as severe, does that leave the bank room then to raise rates because it's two cities being affected?
Well, that is a tricky question, because for every person that thinks that the vulnerability we're looking at would be reason to hesitate to move interest rates higher, there's someone else that thinks it's a perfectly good reason to move interest rates higher. Who's right? And, it's a classic on the one hand and on the other hand kind of question. And so, certainly what what we're cognizant of is that there's been an increase in debt in the economy, so that, interest rate sensitivity could be higher going forward than it has been historically. But I'm reminded, particularly by the correspondence flow that I get, that there are an awful lot of people out there who don't have mortgages, in fact have assets, and are quite critical of how low interest rates are. And so what happens when interest rates go up to those people is they have more income. They have more spending power. These are retirees and so on. And so it's important to understand that the average consumer out there is not the highly indebted 450% consumer that we're concerned about in the tail distribution. The average consumer has actually assets and no debt. So there's a lot of assets out there, which means then that the macroeconomic response to movements in interest rates is being made more complicated by all this. But it's not just the people with mortgages that are affecting how that outcome would play out. That's a long way of saying that there's no direct answer to your question, and perhaps the NPR is a better setting in order to bring some more of those issues to the table. Around what is the balance of risks around the interest rate outlook. But at this stage, I'm just comforted by the fact that the economy is showing better dynamics, and that does go into this equation of financial risk as a positive. It means that the resilience is rising in the background, even if the vulnerabilities are also rising in the foreground.
Omar, CTV.
You talked a little bit about the policies that were implemented in Vancouver to cool the market, and how the effects of that cooling now appear to be going in the opposite direction. It was temporary. I realize the situation in Toronto may be still quite new, that there may not be sufficient data. But what are the early indications showing? Do you see a similar trend developing in the Toronto market as well? Or do you think Vancouver and Toronto are too different? There are differences in those two markets, and that may not necessarily be the case.
Well, I'll start with the fundamentals. The fundamentals they share, okay, which are strong employment growth, strong immigration levels, to go with that employment growth. And so the fundamental demand for housing is strong in both of those markets. And so this is not not by any stretch an entirely speculative situation. There are fundamental drivers that pushing the demand for housing, and with constraints, as we are well known in both of those cities, constraints on where growth can happen in housing, that prices have a tendency to go up. And what we've said is that prices appear to be rising faster than any fundamentals that we can identify. Therefore, there's a role from extrapolative expectations. But on the specific policies that have been put in place, it is obviously very early days for the Toronto area. We just have one data point, which is suggestive that there's a reaction. But before I turn it to you, I want to say that what we often forget is that there's a supply side to this. And so what we've seen, the most important thing we've seen in Toronto is a very big rise in supply of houses that people are willing to sell. And that's, when you think of there being a constraint on there's only so many houses and we can only build so many new ones, single family homes or condos, but actually there's an implied supply there, and the higher prices, bring out those decisions. So I've set up the fundamentals, and you can talk about the policies.
Yeah, I mean, you just look at what happened in Vancouver. As the governor said, the activity started to slow before some of the actions were taken that targeted that market, specifically the tax on foreign purchasers. And of course, after that, the sort of slowdown was accentuated in activity and in prices. And more recently, we've seen that come back up. And that's a dynamic you see with those kinds of policies, whether they're implemented in Vancouver or in other countries. And it's partly because the slowdown comes from an adjustment down to a new level. So the share of purchases that were coming from foreigners actually declined, as you would expect. But if the fundamentals, which aren't changed by a tax, or it's still the same, well, it's not at all surprising that you would see growth rates start to pick back up, and especially if those fundamentals are related to kind of underlying structural issues or just demand, because that's where immigration's ending up, that's where the job growth is. Those are things that aren't changed by one targeted policy measure. And so in the GTA, I agree, it's too early to tell. What you do see is the federal measures that were taken to improve the quality of the debt, so the stress testing on insured mortgages. The biggest effect of that we do observe, which is quite positive, is on the quality of debt. And so you'll see in the financial system review, we've got some numbers that look at the share of very highly indebted households in terms of loan to income has come down quite a bit, and we expect that to come down even more, a little bit more as time passes.
Do you feel as though, I mean, we've heard this theme, it's a reoccurring theme, right? That Canadians are over-leveraged, there has been warning after warning, and in successive governments and also from the part of the BOC. Do you feel like those warnings, do you feel like you're being ignored? And B, why do you think Canadians are ignoring all of these warnings? Is it just because the cost of borrowing is so cheap, or are there other factors?
Well, first of all, no, I don't think we're being ignored. And of course, it's hard to prove but we just don't know how things would have looked if we hadn't been doing this excellent analysis and helping people understand things. So it's always hard to prove a counterfactual, so I'll let you go at it, and I'll just say, of course, we're not being ignored. But I think that, I guess the more important point is debt is rising because people want to own a home. It's not really that complicated, and we've got solid fundamentals that are pushing the price of those homes in specific areas. But I mean, obviously, the Greater Toronto Area, and now what we call the Greater Golden Horseshoe, the GGH, is a pretty big area. And of course, the Vancouver area is pretty big. There's lots of other housing markets in Canada that are behaving completely normally. The fundamentals are solid, prices are rising gently, a little bit more than inflation maybe, but nothing untoward. So we've got these pockets, and important pockets, and those are signs of a solid economy, a good economy, and and Mother Nature does this. So people borrow to buy a house, but when we see the debt to income ratio rise, now it's usually not because everybody who's got debt borrowed some more. It's that some new family who has no debt has entered the housing market for the first time, possibly at a high ratio, possibly, at these 400% or whatever mortgage to income ratios, possible. So when you add those folks at the margin, those numbers creep up, but it's not like the whole thing is becoming less sustainable. Indeed, with the new rules in place, we know that those folks have been stress tested quite well. They're able to withstand as much as a 200 basis point renewal rate increase, and because they've got the income today to handle that, even though that renewal might be 5 years from now, or depends on what they've chosen. But the point is, they've got time perhaps to have a higher income by then too. So in other words, the sustainability ingredients are all on the rise, and so it's important not to think of your typical indebted family becoming even more indebted, and that's why we went up in that ratio. And so the situation may be no less sustainable today than 6 months or a year ago. In fact, even though those imbalances that we point to on those macro measures suggest the primary one is the housing one. I mean, the indebtedness one, yes, the numbers are still rising. Yes, we have concerns about some of the things we're seeing. But as a system as a whole, I believe the sustainability is improving steadily. And the important one that we mentioned is that the economy is strengthening. And that's the base for the whole thing.
So we'll wrap up with Andy from CP.
Governor, I was wondering, you sort of touched on this a little bit, but do you feel like enough has been done at this point to cool markets in Ontario and BC? Or, should governments and regulators be looking at using additional macroprudential measures?
Well, I think I'll just go back to what I said before, Andy. It's simply too early to say. And of course, and importantly, even in Vancouver, where we say it looks like the policies had a temporary effect, they may have had a more significant effect on psychology. So when we talk about the extrapolative expectations, it's not a very firm concept. It's not something we can measure as economists because it's a highly psychological thing. So this, FOMO, fear of missing out. I need to buy a house because if I don't, I'll never be able to get a house. That's something I hear a lot. And so what drives that psychology is the fear of another 30% rise in house prices. So if that psychology is there, and then you put in a policy like what we had in Vancouver, and it suddenly goes down to, I guess we're about 10% at this stage, well, that's a pretty big shift. And if that affects your psychology, so it's no longer automatic that I'm going to make 20 or 30% on this, or that I'll miss out, if I don't jump now. That effect can be pretty significant, and that's an element of demand for housing, which is kind of transitory, right? It's people, in effect, buying houses to sell them relatively quickly, et cetera, so that speculative layer can be significantly reduced by a shift in psychology, regardless. That's what I meant when I talked to Andrea about. We already know what the catalyst might be that can cause a retracement in prices. So I don't want to underestimate the value of those things. We're in a space where psychology plays an important role. And I think talking openly about the risks, as we do here and as FCAC did yesterday, I think those are positive things that we can do to help people make good decisions. So I guess I'd leave it at that.
Bank Review also was saying that, the share of uninsured mortgages has increased, and the characteristics are showing more signs of risk. Can you tell us a little more about that and your concerns about this and what can be done perhaps to address them?
Sure. Carolyn, why don't you do that?
Sure. Well, as house prices rise, as you remember, you can't insure a house that's worth over $1 million. So just by construction, you would expect a rise in the share of uninsured mortgages. And in a sense, when you've got at least 20% down, that's actually a good thing, because that means that there is some collateral there if house prices adjust. And it also means that the starting point position of the household is got enough money to buy the house in that sense. And I think where we see the signs in some parts of that market are really with respect to just an increasing share of those households who have loan-to-income ratios that are over 450%. We've seen that decline in the insured space, but in the uninsured space, it's gone in the opposite direction. I think another thing is that the share of those mortgages that have an amortization rate of over 25 years, people will do that because it means they can stretch their payments out, their payments are lower. So it just means that there's less flexibility if they run into financial difficulty to make even more adjustments. I think the final thing is that there's signs that there's some co-lending going on. If it's the what people have called the bank of mom and dad, that's kind of one thing. If it's drawing on lines of credit or having other secondary loans, then of course that does change the financial profile of the borrower in a way that's significant. So those are the things that are on the other side of the 20% down that we pointed to in the review.
Well, I think that does it. We'll see you next quarter.
Well, see you next month, actually. For the
All
end.
right.
Yeah, thanks very much.